Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. In continuation with our series on podcasts regarding our H2 outlook, gradually shifting preferences, in today's episode, we discuss our views on FX and commodities. A quick roundup of what happened in FX and commodities markets so far. After a strong recovery from December 2021 lows, the INR remained under pressure against the US dollar for much of the first 6 months in 2022 amid escalated geopolitical tensions, rising commodity prices, strengthening US dollar, and sharp foreign investor outflows. Over this period, Brent crude oil rallied 48%, US dollar over the DXY index appreciated 9% to decadal high, while the INR depreciated over 6% against the USD. Now, given this backdrop, let's discuss our views on FX and commodities. For the INR, we expect it to remain range-bound over a 12-month time horizon. Above-trend domestic growth, strong FX reserves, improving real yields, and light foreign investor positioning in both equity and bond markets are key factors supportive of the INR. However, deteriorating external accounts amid rising import demand, elevated crude oil prices, lower INR carry spreads, and sharp foreign investor outflows are likely to exert downward pressure on the INR. On the USD, over a 6 to 12 month, we have a bearish bias. We expect the USD to peak in H2 for the following reasons. First, hawkish Fed policy expectation fade as inflation moderates. Second, global central banks continue to tighten monetary policy to avert currency weakness that amplifies inflation. Third, capital flows rotate away from the US towards more attractively valued assets. Fourth, steady de-dollarization continues. And fifth, uncertainty rises around US politics and future policy direction. The USD has already priced in aggressive Fed hikes, slower global growth, and considerable safe haven risk. The timing of the USD reversal will likely be driven by the speed of policy convergence, China's economic stimulus as it exits zero-COVID policies, and some form of resolution in the Ukraine war. On the gold, we feel it remains a key portfolio diversifier. Gold prices have pulled back from the year's high of USD 2070 in March. However, we believe gold should be an integral part of clients' portfolio. First, we continue to believe that USD will peak, and historically, gold has done well in a weaker USD environment. Second, there is an increasing risk of recession. Gold should benefit from safe haven inflows in the event of significant slowdown in growth or possibly a recession. And lastly, central bank reserve diversification remains a structural theme, and we believe gold will increasingly make up a larger component of central bank reserves. On a shorter horizon, Russia-Ukraine tensions could continue to flare while US-China relations remain strained, leading to upside risks for gold. Oil may see higher prices still. We maintain a bullish view on oil prices as low supply growth, tight spare capacity, and low inventory outweighs worries of a slowdown in demand led by falling global growth. Following the EU's embargo on most Russian oil imports, we expect global crude oil price supplies to shrink further. Additionally, supplies in the US Strategic Petroleum Reserve fell to the lowest level since 1987, and global oil inventories remain at multi-year lows. As China potentially begins to ease its lockdown measure, we see further upside risk for oil in such a scenario. A key risk to our view would be a deep global recession to demand destruction. That's it for today, and thank you as always for listening. Do reach out to your relationship manager for a copy of our H2 Outlook, Gradually Shifting Preferences. If you like this podcast, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.